Hello and welcome to this very special interview on Moneycontrol. I'm Mahalakshmi and I have with me a rockstar investor, Saurabh Mukherjea of Marcellus. Good morning, good morning, Saurabh, and
Morning, Mahalakshmi. Good morning.
great to have you today morning.
Thank you for inviting me.
First
Thank
things,
you.
first things first, we are at an all-time high. What is the sense you're getting compared to last time, this year, and this time? Where are we headed next?
I don't think we could have asked for a better confluence of factors. Not only are we seeing a broad-based economic recovery, you will have seen in the recent second quarter earnings across the piece from IT services through to banks, through to power and infrastructure. You're seeing a broad-based economic recovery. You can also see that in the GST collections, in the power consumption data, in the airport passenger data. And alongside the broad-based economic recovery, we have China shooting itself in the foot on a weekly basis, right? Which means that foreign investor money, which had historically gone to China over the last 20 years, both FPI and FDI money, which had historically gone to China, that's now making its way towards India. We've seen the early evidence of that. I think there's much more to come there in terms of FPI and FDI money. So great set of factors going into 2023.
And do you really think the global macro risks are now decisively behind us, or do we have to wait for more data? Because we have just had one inflation print lower than the previous one. It's not really a trend that has been established yet. What is the sense you get?
I mean, look, Mahalakshmi, the global macro piece is always a sort of endlessly, what should I say, problematic piece. That's the 100 trillion global economy. Whatever happened in 2022, I'm sure a completely different set of global risks will emerge next year. It's always ever been thus. Either the Fed is cutting rates because there's some sort of financial crisis, or the Fed is hiking rates because inflation is through the roof, or there is a war somewhere. The global piece will always pose a bunch of complications. I've rarely lived in my investment career. I've rarely seen a year where the global sky is blue, the birds are chirping, it's a cloudless scenario. There's bound to be some risks. All that you and I can do is focus on the factors that we can observe and control to some extent, which is the domestic economy. What we have in India is a pretty solid domestic setup. As I said, well-run companies are reporting 20-25% profit growth over the last 6 months or so. The banking system is in good shape, and it looks to me that given what's happened in the broader global ecosystem, the world is now coming to India, both in terms of FPI money coming in and the FDI piece coming in, especially sectors like smartphones, API pharma, medical equipment, and so on. So I'm not so sure I've got any great insights on global, but I don't think anybody does either. We shouldn't sort of wait for global to become a blue cloudless sky. That's not going to happen. वो नहीं होगा. Focus on domestic, focus on buying high quality, well managed companies.
So overall for the market and also for the sectors that you probably look at, how do you see the valuation range right now? Is that something that worries you at all? I know that you don't pay too much attention to valuation. You like the quality of business, you like the quality of management. It's a go for you. But on a
No.
relative basis,
So if you look
sorry.
at that, right, I think we are in pretty solid territory. So let's take, say, our flagship product, Consistent Compounders, is now 4 years old. We've delivered around 19% returns. If I look at free cash flow compounding of the CCP companies, that's also been around the 20% mark. So over a 4-year period, you've compounded share prices at 19%, and free cash flows have compounded around the 20% mark. If I take the market as a whole, 5-year returns would be around 13-14%. 5-year earnings compounding has been 13-14%. So I'm not so sure the valuation issue is particularly pressing. As you and I have discussed in
Yeah.
other such fora before, a lot of people in our country get very worked up about PE multiples and they jump up and down.
Right.
I've never believed there's any joy to be had. But even if one steps back and looks at earnings and free cash flow compounding over the last 3, 4, 5 years, they have kept up with share prices quite nicely.
So that's one point I wanted to ask you, Saurabh. One huge difference between where we are probably headed now versus what the last 10 years has been. The last 10 years was nearly a lost decade for the Nifty because most of your, industrial sector economies led by banks did not perform. They didn't contribute to earnings growth at all. In that context, obviously, consumers, high quality businesses, which were insulated from all these issues, did exceptionally well, and that's also a piece that you have liked, and that strategy worked beautifully. Now, the banking story is very different from what it was about 10 years ago. We've seen, the balance sheets are pretty much clean, credit growth is taking off, there is expectation that capex led recovery will come back, we don't know when. So, in the wake of this sort of a recovery and setup, do you think the next few years could belong to that category, and could the quality pack see some kind of moderation?
So I've been in the stock markets for 20 years, and throughout my 20 years, I've heard this, that any day now, the quality guys will drop away, and low quality public sector institutions, low quality public sector company, low quality metals mining companies, power infrastructure companies will come, and unka time aega, and because we've underperformed for the last 12 months, a lot of people keep telling me unka time aa gaya hai. And I can't deny that last 12 months, public sector institutions, whether they make defense equipment or that they give loans, public sector institutions have had a great run. And similarly, metals mining, power infrastructure, telecom, these sorts of conglomerates have done well. The only fly in this ointment, and the reason we stay away from these sorts of firms, is there is no business engine in these businesses, right? If you take a typical public sector institution, return on capital will be significantly below cost of capital. If your return on capital is below cost of capital, whether you're a metals and mining company or a public sector company, if your ROE or your ROCE is below cost of capital, you're not generating a surplus. If you can't generate a surplus, you cannot grow your business. So yes, you will have your moments in the sun, and PSUs and power infra, metal mining companies are having their moments in the sun. But even when they're having their moment in the sun, even then they're not generating a surplus, and therefore we can't go and stick our money there given the underlying fragility of these businesses, and we carry on doing what we've done for the last several years, which is buy companies to make a ton of free cash flow, right? More than pat, we're looking at free cash flow. If you look at the BSE 500, Mahalakshmi, in the BSE 500, you have barely 60 companies who are
Hmm.
able to generate free cash flow in a relatively consistent manner, right? And amongst those, the ones that have come off, we have loaded up heavily on them. So, for example, through June, July, we increased our position in Dr. Lal by around 400 crores. Through the last couple of months, we've increased our position in Divi's Lab. Uh, the basic the basic tenet of investing is look for companies which make money, free cash flow, right? And then if they become cheap, buy tons of it. We did exactly this with Bajaj Finance. I remember in April 2020. The stock had come up, I think, 60 odd percent in 3 months, and we doubled the position in May 2020. That's worked out, and I hope that our investments, the ramped up investments in a DV's lab, in a Dr. Lal, in an HDFC bank, will work out in a similar tenor. So I congratulate those who have made money in public sector banks and metals mining conglomerates and so on. But I'm afraid if the company doesn't make money in terms of free cash flow, difficult for us to put our finances in there.
So the rest of the so clearly, obviously, the return ratios for consumer businesses and several other businesses that you own and also talk about are superior, but in a phase where you see an industrial recovery, do you think those businesses themselves are not geared in a way or structured in a way that they can deliver a superior return on equity? Because if you just look at, rewind and go back 10 years, you would still find a lot of engineering companies which probably did very well. I can't say the same thing about metals because metals is a slightly different business. But there are other businesses you might still be, able to generate higher returns than cost of capital. Is that something you look at as a playing ground? I mean,
So
could
look,
that really
if
help
you
the
if
equation?
you are if you are able to find an engineering company with say return on capital consistently above 25%, which almost assures your free cash flow. If your ROCs are consistently above 25, or a pharma company with ROCs consistently above 25, which assures you of consistent free cash flow. So regardless of sector, if you have a company which consistently does ROC of 25 or better, which means hefty free cash flows, and they are reinvesting those free cash flows, Mahalakshmi, then I think regardless of sector, people like us will have a look, right? And if we find that the promoter, the management team are doing a sensible job of running that franchise, I think everybody will be interested in running in investing in these companies.
No, I
Historically, the
guess what
challenge
happens is that because those tend to be cyclical, I mean, I guess you have to sort of time it
I
in a
think
way that
beyond
you
the
are able to
cyclicality, I think
play
beyond
the
the
cycle.
cyclicality, beyond leaving aside the cyclicality, our country historically hasn't had too many companies in, say, heavy industrials or T&D or power and infrastructure. Our country historically hasn't had too many companies who actually have a moat and therefore can generate a ROC above 25% consistently, regardless of the cyclicality. Right. So I remember doing this analysis in my erstwhile avatar. I went, so this is 5 or 6 years ago. I went through 20 years of data, and I
Hmm.
tried to figure out, is there a case for buying cyclicals in our country, the highest quality cyclicals in our country, right?
Yeah.
And even if I was God, right? I did looked at the data and said, even if I was God and I could market time, even then it was a very tenuous case
Hmm.
for high quality cyclicals. Now that doesn't mean that next 12 months high quality cyclicals won't make money. They probably will make money, given that, as we discussed, it looks like a broad based economic recovery. The
Hmm.
challenge there tends to be, once the first flush of cyclicals make money, new capacity slams in super fast, right? So whether it is
Destroys value
construction,
in the downturn.
right? And as soon as new capacity comes in, because barriers to entry are low, the moats are shallow, the 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 initial champion fades away very quickly. And since you and I can't time this, our viewers stay away and carry on investing in the companies that are not cyclical but consistently give you free cash flow growth or profit growth of about 25%. So, in an economic recovery, the company which consistently does 20% profit growth becomes unfashionable. And that's exactly our time to load up even further, right? And hence, I gave you the examples of Dr. Lal and Divi's. It's an economic
Right.
recovery. Those stocks are unfashionable. And we therefore put in hundreds of crores, as much money as we can deploy. We deploy there.
Sure. So you talked about HDFC Bank. Now, HDFC Bank this year has been a terrible underperformer. I think 5 4 5% return this year till date. You look at an ICICI or a SBI, they've done about 20, I think 25 26%. Even the BankX has done much better, 18 20%. Now, what is your sense in the last 2 3 years? Obviously it's gone through some sort of a derating, and part of it is probably because of the bank itself, or part of it is probably because the rest of the banking universe started looking better because the complexion of business has improved. How do you see that going from here in terms of differentiation in business, in terms of their ability to, yeah, you keep credit costs low? Do they still have any significant differentiators that should allow them to regain, uh, uh, you know, uh, to get a better rating, get revalued over the next
So,
two
so
years?
let's look at the business, because on the business front, they have, in the last 4 years, they've actually pulled away even more from the banks that you referred to, right? On the market share and on the non-performing assets front, they've pulled away. So, in the last 4 years, their market share has gone from 7 to 11%, pretty much both sides of the balance sheet, right? If you add up all the private sector banks and SBI, you will
Hmm.
not get to 4 percentage points market share in 4 years. So, all credit to Sashi Jagdishan and team. It's been a remarkable performance, right? If you can imagine what we have been through as a country in the last four
Hmm.
years, right? GST, COVID, GST, demon, all that. And these guys have gone from 7 to 11, both sides of the balance sheet. In fact, if you look at HDFC's own history, man, if you just imagine, right, from 95 May founding till
Hmm.
2018, that got to 7%, and they've gone from 7 to 11 in 4 years flat, right? Remarkable show, both sides of the balance sheet. Whilst they have done that, their net NPA numbers are one third that. One third. Net NPA numbers are, the gap between HDFC Bank and everybody else is widened even further on the net NPA front, right? And in addition to that, as everybody would have heard, they have announced what I think is a remarkably good deal with HDFC Limited, where in one fell swoop they will they'll get a mortgage book bigger than ICICI and Axis's mortgage book put together. So as we see, the quality of the business actually has improved very substantially. HDFC Bank's quality of business has improved very substantially. The bank's muscle and might has improved very substantially in the last 4 years. And therefore, since the market hasn't ramped it up, we have loaded up heavily in recent months. In fact, we carry on buying HDFC Bank in ever larger quantities because of exactly this point. The bank is getting better year upon year, becoming significantly more muscular, stronger, more skilled. The stock market isn't seeing that, and therefore gives us an opportunity to ramp up. We have ICICI Bank in our Kings of Capital portfolio. Bakshi Saab has done a superb job in taking an institution which was in all sorts of trouble on the HR front 5 years ago, and all credit to Bakshi Saab for rebuilding morale,
Yeah.
bringing the top team, which is doing a great job there. So we have it in Kings of Capital, but whether you compare SBI with HDFC Bank or ICICI with HDFC Bank, there is not just daylight. The gap is actually the performance gap is getting wider. And remember, HDFC Bank is delivering for you 18% ROE with 9 times gearing. SBI is delivering for you 18% ROE with, I think, 16 or 17 times gearing. Right? It's the same ROE. One bank is doing it with half the leverage of the other bank. Right?
Hmm.
Uh, and that tells you, I think, the all you need to know about where conservative investors like us will be investing.
So my question is, so where do you sit, how does the value gap really emerge out here? Do you see a valuation re-rating? What is it that the market is really missing? Of course, one part of it is this technical overhang. But that apart, is it just that in the last few years, it's relative performance that has kept investors away
So let
from
me
this? Or,
simplify the problem. Simplify the problem for your viewers, right? It's lot of obviously. Let's focus specifically on banks because a lot of people are very excited about public sector banks these days. So if you leave aside SBI, I'll come back to SBI in a minute. If you leave aside SBI, the other large PSU banks, their 5-year share price return is zero. The 10-year share price return is zero. 5-year share
correct.
price
Those
return.
are, I think, even the NPA problem has not really gone away, because if you just take out the top two, even Canada and Bank of Baroda, the rest of them will still have 3-4% or more in terms of net NPAs.
Right.
So that's,
Right.
I don't
So,
think it's
so
going
as
to
you
go.
so as you were saying, right, because their NPA problems have gone away, the typical public sector bank, the return on equity is consistently below cost of equity, which means value generation is zero, and that's
Hmm.
reflected in 5-year and 10-year share price movement, which is zero. All that happened was from say 5 years ago to the height of COVID, they went down, and then from the height of COVID, say summer 2020, they've come up, and therefore from summer 2020 to now, their share price performance looks very respectable. All credit those who are watching. If you bought public sector banks in summer 2020, a lot of credit to you. You have courage, you have foresight. We didn't buy them in summer 2020. Those who did have clearly made a lot of money. But if you step back and look at the fundamental story, zero value creation, zero share price movement, and there's zero wealth creation on a 5 and 10 year horizon.
Hmm.
SBI now, coming to SBI, SBI share prices doubled over the last 5 years, right? So they have compounded roughly at around 15% over the last 5 years, which is a credible performance given all the challenges that SBI has historically had.
Yeah.
Compounding at 15% through a tough 5 years has been a very credible performance. And I think a lot of credit should go to Arundhati Bhattacharya for running a very for improving the efficiency and quality of the bank. Will SBI continue doing well going forward? I think so. I think SBI as a bank, because the worst excesses of crony capitalism, the worst
Hmm.
excess of crony capitalism seem to be behind us. The kind of mass destruction of SBI's balance sheet, which
Hmm.
happened a decade ago, hopefully is not going to happen again. And provided mass destruction of SBI's balance sheet doesn't happen again, I think SBI should be a decent compounder going forward. Our goal is to help our clients get to 20% compounding. Given SBI's fundamentals, right? As I said, they're geared very heavily. 17, 18 times gearing
Hmm.
is a little too stressful for people like us. We'd much rather go with a Kotak Bank at 6 times gearing or an HDFC Bank at 9 times gearing. Given SBI's gearing, we are not able to back a bank which generates 18% ROE but on 15, 16x gearing. We would much rather go with an HDFC Bank which does an 18% gearing, 18% ROE on 9 times gearing, and with the further prospect of the HDFC Limited mortgage book slamming into HDFC Bank, and thus giving HDFC Bank for the first time access to the stickiest asset in
Hmm.
Indian banking, the stickiest asset being home loans, where they historically haven't had a presence because HDFC Limited was playing that role.
So you are optimistic on HDFC Bank, because I saw the last 2-3 portfolios you seem to have trimmed some exposure.
we're buying more of it in most places. In certain clients' portfolios that was say, created 4 5 months ago, they would have run up, right? HDFC Banks actually had a good run in the
Sure.
last few months. So in every portfolio, we position size basis our view on the fundamental strength of the franchise. And if the stock then runs up, we obviously pull it back to the position size and vice versa. If it runs down, the
Sure.
position size back up. Generally, most portfolios we are ramping up because the value is pretty evident there. The reason I don't lose too much sleep on this re-rating, de-rating businesses, I honestly have no idea. Other fund managers tend to have divine insight on say price to book multiples. We have no divine insight on price to book multiples. Our call fundamentally is the
Hmm.
book value per share, whether it's an HDFC or a quota, the book value per share will grow at around the 20% mark, which will get us what we need. Some years the price to book will go up, some years it will go down. Since I can't second guess what will happen which year, focus on the BVPS and stay with that number. HDFC Bank for 25 years has given you BVPS of around book value per share growing at around the 20% mark.
Sure. Fair enough. The other question is on Asian Paints. Again, it's one of your favorite stocks. My question here is now, Buffett has this quote where he says, an excellent management pitched against, the reputation of the business. If the business has a bad economics, then, a brilliant management cannot save it. Uh, in Asian Paints now, the biggest problem, I mean, no question about that. The fact that the management has been incredible. They've been for years and years grown, created a fantastic moat and have been able to deliver very high ROE. Now, do you see the complexion of the business itself changing because of all these challenger brands, whether it's JSW or Grasim? Can that come and really spoil the party for Asian Paints? What are your thoughts?
So look, a lot of people have tried over the last 20 years. I think Asian Paints is no great secret, right? I think ever since I was in primary school, this company has been growing its business at around 20%. So I remember when I was a child, I used to hear about Shalimar Paints. I don't hear so much about them anymore. When I migrated to India 2008, I heard about a company called Sherwin-Williams, which is the world number one, and they seem to exit the country within 3 4 years of entering India. Then a couple of years ago, I think when COVID began, we heard JSW Paint making a lot of noise. I don't hear so much about them these days. I think they said roughly now they're expected to be at a 2,000 crore top line. This is I think JSW Paints' press announcement from 3 years ago. I don't think they've got anywhere close to 2,000 crores. And as you're alluding to, Mahalakshmi, I think lately we heard a lot about Grasim's aspirations in
Yeah,
paint. I'm sure they will have a crack at it. And they should, right? This is a competitive, free market economy, and we need our companies to be kept on their toes by credible challengers emerging. But the barriers to entry are extremely high, and whilst we remain keen to see Grasim enter the space and actually do Asian Paints run for its money, but we're keen to see that. In the meantime, from what we can see from our dealer checks, Mahalakshmi, Asian Paints has cleaned up the putty market where the Birla brand was the dominant brand. Asian Paints seems to have completely cleaned up that space. And if you look at last 8 9 quarters volume growth, Asian Paints' volume growth numbers are coming in, I think, around 15 16%. I'm sure they're boosted by putty because they've grabbed the putty market at rapid speed. But even if you take putty out, I think their paint volumes themselves are actually will be growing at the low teens. And I'm pretty sure the paint industry isn't growing at low teens, which means Asian Paints is grabbing market share quarter upon quarter and continuing to grow profits and free cash flows at the old rate 2025. What I find really exciting, which is leading us perhaps to even think about ramping the position up further, is their home decor foray. I think it's been thought through brilliantly by management, and effectively it's the formalization of say your home decor for people like you and me, right? In the old model, someone like me used to hire the local artisan, the local mason. He would come and have a look, and he would take out his
yeah,
pencil and and say ye kharidna hai, wo kharidna hai. Then he would go to the local market, get things, knock it together over Saturday, Sunday. That model is gradually going to fade away because people like you and me are a little too busy to project manage our home decor. Plus, the plumber, the artisan, he
yeah,
himself wants to formalize. So, what Asian Paints is doing brilliantly is juxtaposing itself between Mahalakshmi and the masons, and they're saying we will design and project manage your home decor, and you can track the whole thing on your smartphone, Mahalakshmi. Um, it's not costing them a lot of cash. The business is profitable. Paint is roughly a $10 billion business industry, in which Asian paints is roughly half of it. Our reckoning is home decor is a $50 billion market. And if Asian Paints ends up even with 10% of this $50 billion market, broadly speaking, we reckon a decade hence the home decor business will be as big as the paints business is today. So that's where that's why you invest in great management teams. You invest in great management teams because they have a the ability to generate surplus cash, and b the strategic smarts and just the sheer hard work. Right, you roll up your sleeves and build giant businesses, create billions of dollars of value. It's a very rare skill, and these guys have done it for 40 years. So as everybody knows, we have a large position. Doing more work on the home decor business, and looks of it, this could be the trigger for another layer of Marcellus ramp up, potentially in Asian paint.
Sure. So no question, again, the management's ability to, reposition its business or change its, alter the, the key constituents of its business, all of that can happen. My question is, in the interim, let's say, every time a money bag comes and disrupts a business, they obviously stir the market. I mean, they may not do the right things. They may not end up as a great a player, or they may not even succeed in capturing the market. Like you're saying, this is a high entry barrier business, but they can still damage the business somewhat in the interim. So I'm saying
Not really. I
in
think
the long
I
term,
see it
let's say two,
positively.
three
See, you got to
years,
keep. I think it's a
is that
positive
something that
sign.
worries you?
You need the
Sorry.
money bags to come in and talk a good game on media, right? First off, so three things we ask money bags to do vis-a-vis Marcellus portfolio companies. In fact, I just finished a meeting with a foreign investor, and I told him that, look, this is the Marcellus portfolio. Foreign investor obviously knows our portfolio because he's invested with us. And I said, can you please encourage the other private equity or venture capital firms you've invested in to rattle the cage in the media and say that they will compete with the Marcellus investee companies, because as soon as that happens, right, it energizes our investee companies. My telling our investee companies that, look, can you work harder, is less
Mm,
useful than a money bag coming on your channel, on your show, and saying, I've got these grandiose plans to take on Marcellus's investee companies. It's a very, very powerful effect. So that's the first thing we ask money bags to do, is talk a good game, have grand plans vis-a-vis how you're going to thwart Marcellus's investee firms. The second thing is we encourage them to, hire good people, because what that does is it gets the talent market energized, right? Our investee companies then do a better job of incentivizing, comping their talent, ESOP plans. Suddenly, ESOP plans in companies that have never had ESOP plans emerge.
mm,
Great to see that. We love to see our investee companies incentivizing their employees through ESOPs. The promoter suddenly wakes up and says, my prodigal son or daughter will not sort of inherit this as a kind of right of course. I might even get a high quality CEO. So we need this aspect in corporate life. We need a more competitive economy. We need companies, new entrants to come in, talk a good game at the outset, hire good people, and give our investee companies a run for their money, because that's how our investee companies will get more efficient. As they go more efficient, the return on capital goes up, more cash will come out, we will compound faster.
fair enough. That's a very counterintuitive way of thinking about competition. But Um, the other question is on internet businesses, sort of. Now, obviously, from the IPO levels, many of these companies, whether it is Zomato or Nika or Policy Bazaar, all of these have strong moats. They're established leaders in their businesses, and these can sort of, once you establish your leadership, they can throw cash flows over the long run. How do you look at these businesses that, again, I mean, I don't want to talk about valuations, but then the fact is that valuations have dropped quite considerably from where we were at the start of the year or even last year. Do you see these as high moat businesses that could transition into high cash flow generating businesses in future?
So look, Malak, I take this question. I really enjoy talking to you, given how interesting your questions are. We could do this for hours. Let me take this question and then I'll head off to my next meeting. I think internet businesses, I think Nika is probably head and shoulders above other internet businesses that have been listed. I don't know about the unlisted businesses so much, but in the listed internet businesses, I think Falguni Nair and team have built a franchise which makes money, generates a little bit of cash. We're a little perplexed at their foray into apparel. I have to confess, in BPC, they've done really good work. They're generating cash. Uh, we haven't invested so far because we're not yet convinced that in the BPC segment, their technology is as good as it can be. Right? This is a well-managed company. We think they could tighten up on technology. We've done a lot of sort of mystery shopping on their platform. My younger colleagues out there, male and female, have done a tremendous job of mystery shopping on their BPC platform. Hopefully, they will strengthen the technology moat, and hopefully, the little bit of surplus that they make on BPC, they will deploy it sensibly. But if I compare Nykaa with other internet businesses that have been listed in the last week or so, Nykaa is, I think, a different league. It's like comparing Virat Kohli's batting skills with my more pathetic batting skills. I don't think the rest of the internet businesses that have been listed have been warranted discussion, Mahalakshmi.
Okay, one last question. And this is really the last question. So, your stated strategy is in the realm of these quality companies. Some of them will perform in a year, in a given year. Some of them will underperform, and you will juggle between those stocks to ensure that you stick with the right ones. In the current markets, what are those companies that you are backing or are on your tick list, and which ones are you
So if
underplaying?
I think in the large cap portfolio, it's consistent compounders, as I said, we've ramped up through the summer in Dr. Lal, we've ramped up in Divi's Lab, we've ramped up in HDFC Bank, and those are the two big sort of increase your position size. In the small cap portfolio, Little Champs, we have increased position sizing in alkyl amine, that's come off in the last year or so. We've increased position sizing in Suprajit and Little Champs. We've also increased position size in VMart and Little Champs. In Rising Giants, the mid cap product that was launched in August last year, where we are down 10% in terms of share price action. Profit compounding is 20, but we're down 10%. In Rising Giants, we've ramped up further in ICICI Lombard over the
Hmm.
last 6 months or so. We have ramped up further in alkyl amines there, and we've increased the position in GMM further through the last 6 months.
And where are you turning bearish?
I think the piece that is looking a little hammered in our country is anything to do with low income consumption. That piece does look a little, in a way, VMART, right? While profits are growing 40-50% YOY. If
Hmm.
you look at sales per square feet for VMART, it is down 10% from pre-COVID to now. And in that period, remember, prices have gone up 20%, CPI is up 20, and for VMART sales to be down 10% between pre-COVID now. This is sales per square feet I'm talking about. I think that's an indication of just how hammered poor people are in our country. So really, Amritanjan, let's imagine, right? Pain relief products strong
Yeah.
in Tamil Nadu, Odisha, Bengal. Amritanjan's revenues are down 20-25%. So I don't think I've seen low-income people in India in this sort of shape for a long time, and that's where we are becoming a little bit more circumspect about just how deep is the pain in the lower income strata in our country.
Right. Right. All right. Thanks so much, Saurabh.
Thanks, Mahalakshmi. Thank you for hosting me. Thank you. Bye.